When we work with any client that either retails or wholesales or uses inventory as a major component of their business, maybe they're a repair company and they've got parts that they keep on trucks. Inventory turn is a critical metric that we need to measure, because what a lot of business owners don't quite understand is that when you have inventory, it's the same as taking cash and setting it on a shelf. If you've got $100,000 worth of inventory sitting in your warehouse, you may as well take $100,000 cash and lock it up, because you can't use it until you sell it. And your entire cash flow of your business is dependent upon you taking that inventory and turning it into dollars. And every time you turn it a complete turn, you're generating more cash flow to help your business grow and to pay your overhead, your rent, your insurance, your salaries, those types of things. So one of the largest strains that we see particularly in wholesale customers, is that our clients, they'll think that they need to have this huge amount of inventory so that they can fill any type of order that might come in at any time. Now, obviously, you want to fill orders as quickly as possible and as efficiently as possible. But if you've got a product that sells once a week, 1 unit per week, and you've got 300 units in stock, well, you've got 6 years worth of inventory there. Does it really make sense to have 6 years worth of inventory? Probably not. So in order to calculate your inventory turn, you take the average inventory for a period. So let's just say for a month that your beginning inventory was 50,000 and your ending inventory was 60,000. So you add those two together and divide by 2, and that's 55,000 for the month. That's your average inventory for the month. And then you take your cost of goods sold for the materials and you divide them, you divide one into the other. So let's say that your cost of goods sold, to make the math easy, was 55,000. Your average inventory is 55,000 and you sold 55,000. So what that's saying is you turned your inventory one time. So you theoretically, every piece of inventory that you had during the month got sold. And why that's important is, when you have a wholesale or retail business, you can only generate cash when you're turning inventory. So the more often you turn your inventory, the more cash you're generating. Also, the more often you turn your inventory, the less cash you have sitting in your warehouse. So if you are only turning your inventory one time per year, that means you have an enormous amount of cash that could be used for other operating expenses, maybe marketing, sales, what have you, to increase your revenue. It's sitting back in your warehouse and you can't use it. So you really, really, really need to be cognizant of what your inventory turn is and what is a good number for not just your industry, but for your business. There are certain times where a lower inventory turn is unavoidable. If you have a long lead time from when you place an order to when the material can actually show up, like if you're ordering from overseas and it's got to come over on a boat, well, then you need to have more inventory in stock. So it's not just an industry thing, it's not just a retail versus wholesale thing. It also needs to get down to your specific business. But that's where a CFO can help you really plan out, how do you maximize the cash you can generate from your inventory without tying up too much of the cash that you already have in inventory that's not going to move.